Welcome to the Valmika Property Investing Podcast, where I, your host, share the key to success in the Australian property investing market. I'm the founder of Valmika Buyers Agency. You can find us at valmikaproperty.com. The contents of this podcast are the personal opinion of your host and are intended for entertainment purposes only. Any financial advice must be obtained from your trusted financial advisor or a qualified professional. In this episode, it's been highly requested by many of our clients to show how to build a balanced property portfolio for retirement. And we get this question a lot at Valmika, and it's basically what people engage us to do for them. So I thought it'd be worthwhile to have an episode dedicated to this topic. Now, this is a very large topic, so I'm going to talk just from a high level, but I still think what we'll be speaking about will be of great value to you. So we'll start off with an introduction to portfolio mechanics and the risk management of property portfolios. We'll then dive into the strategies around building a portfolio. So firstly will be high growth properties. Secondly, how to improve yield on high growth properties. Thirdly, we'll discuss purchasing high yielding properties. Then we'll move on to a topic of short-term equity gains to just give your portfolio a short-term kicker. Then lastly, we'll summarize it all and discuss the balancing act between all these strategies within your portfolio. Then, of course, at the end, we'll go through the property auction clearance results for the weekend of the 17th of September 2023. So let's get straight into it. Introduction to portfolio mechanics and risk management. As discussed in a prior podcast, which is probably worthwhile going over again, and the podcast was the power of leverage. It is the leverage component or the debt component of property investing that accelerates your wealth. And it's very, very important to be able to utilize this extremely useful tool for growing exceptional wealth in property. So what do I mean by this? In your portfolio, it's important to spread out your equity amongst as many assets as possible. So for example, if you had $500,000, there's no point in acquiring one property for $500,000 and not using any debt, because what happens there is you'll be growing at the rate of the market on that $500,000. So let's say, for example, on average in Australia, it's between 8 and 10%. So you're limited to that 8% on the $500,000. However, if you split that $500,000 into $500,000 deposits, and on that, let's say, for example, you purchased five $500,000 properties. So that means your base is growing on $2.5 million at 8% instead of $500,000. So you're accelerating your growth potential by using debt. And why debt is so important in a portfolio is because your debt is historically been always cheaper or lower, the cost of that debt, than the growth potential in property in the right areas in Australia. So think of debt as having a very cheap partner who is giving you majority of the money and only expecting a small portion of the growth of those assets. So you're growing on a much bigger base, and that is the power of property. So once you understand that, that is the core to building a strong portfolio, is utilizing debt. But debt comes with its disadvantages. And the disadvantage is that in order to access that debt from the banks have full security over the assets. So if you can't pay it back, they take the property. So that's where having a balanced portfolio and managing the risk in your portfolio is very crucial to obtaining that wealth in property. And that's what I mean by having a balanced portfolio. What I mean by balanced. So, balanced means having a balance in the portfolio of high growth properties, which generally have negative cash flows, meaning you have to contribute in equity installments every month. It's not self sustaining from the property, but you get that strong growth uplift. So, you have that component in your portfolio. And then, secondly, having high yielding properties as well in your portfolio. Because what this does is, even though those properties may sacrifice a little bit on growth, they give you high income streams, so they're positive cash flows. And this enables your portfolio to stay in the game and keep those properties by managing that cash flow component. And that is the risk element in a property portfolio. So, what is the secret around that? So, if you find that your property portfolio is growing nicely, however, you are struggling to contribute to the monthly payments because it's a negative cash flow property, that is a sign that your next property acquisition in your portfolio should be a high yielding positive cash flow property. So, getting that balance in. So, that property might sacrifice on growth, but it'll bring you extra income to help sustain those payments every month. Then, of course, the opposite is true. If you feel that your property portfolio has great cash flow income, however, its net asset value is not growing as quickly as you would like, then it's a sign to include a high growth blue chip property in there to get that equity uplift that you're looking for. So that's the balance dynamic that you have in a portfolio. And the way to get a gauge on that is the understanding of your cash flow and growth dynamics within that portfolio. Okay, so let's move on to the actual strategies. Let's start off with high growth properties. Now, high growth properties generally tend to be blue chip properties near major city centers. And it's in areas with large and growing populations, with improving income trends, with large employment numbers, access to good transport network. Those generally tend to be high growth properties. So they are in strong socioeconomic factors that comply to be able to have those growth dynamics. But they generally tend, and this is not the case for all high growth properties, but in general, they tend to be negative cash flow properties because they tend to be more expensive to get into. And the actual rental income streams from those properties, because they're so expensive, are very low in yield terms. So what I mean by yield is the total net rental divided by the cost of the property, and that's your yield. And in high growth areas like Sydney, for example, you're tending to yield at the moment between 2.5% to 3.5% gross. However, the growth potential of those properties are exceptionally high. Now, this is not the case for all growth properties, and I'll discuss that in more detail later. However, when you acquire these growth properties, I generally tend to like to improve the yield dynamics of those high growth properties and try and turn them into almost being cash flow positive, if not cash flow positive. And there's different strategies you can employ in your portfolio of high growth properties to improve their yield. And that can be as simple as, if you don't want to put in extra capital, as renting out individual rooms instead of the entire property itself. And people will say, well, can you do this? Yes, you can do it. Obviously, you have to look in terms of the regulations and getting insurance for the potential risks that include in that, but that'll be all part of the cost. So, for example, simplest way to do it is when you rent out the individual rooms, and I'll give you an example. There was an asset in Manly, 3-bedroom apartment, nice square meterage under roof. Instead of actually renting it out as a 3-bedroom unit, it was rented out as individual rooms, and it was rented out to young professionals. And this particular asset had doctors, so young doctors doing internship. They were commuting to the city using the ferries, and they were happy to rent out those individual rooms. So there was a couple of doctors in there, young doctors. And the actual rental income increased by 50%. This is obviously a few years ago, but at the time, the rental for that unit was, this is a couple of years, so it's much lower than it is now, but was on $800 a week for a 3-bedroom apartment. But renting them out on an individual room basis, it increased to $1,200 per week. So that is a 50% increase in the actual rental income stream. Just doing a simple thing like renting out the individual rooms. The other thing you can do is actually converting the rooms of a home into standalone rooms. For example, you could add in bathrooms into the rooms. You could add in or section off different areas of the house so that it provides more space and more privacy to those rooms. And so it involves a little bit of a capital outlay. However, your income streams will increase. And this particularly works well in areas near educational centers like universities, for example. Purchasing a home, converting the home into individual rooms for students to rent out, and then renting it out. And that proves to be a huge increase in income stream. And bear in mind that even though you may convert the home now into those individual dwellings, when you decide to sell the home in 3, 4 years, 5 years time, wherever it is, you can always convert it back if it makes sense to you, if you can get a higher equity uplift in the sale as an individual home than in a border type of dwelling. But obviously check the regulations around it, but these are very, very useful strategies. The third way to increase the yield on these high growth properties in your portfolio is to create an extra income stream off the block that you purchased the home on, for example. So if you've purchased the block and it's, say, 700 square meters, you can put up a granny cottage, for example, and rent that space out. So you might find it'll cost you a couple of $100,000 put up the cottage, but the increase in revenue income stream, just in the base of that small investment, the yield increases substantially. And not only does the yield increase substantially, but the valuation of the home increases substantially as well, because having a granny flat on a freestanding home on the block is very much in demand. So when you sell it, the valuation of the property just increases with it as well. And keep in mind that even though you're contributing to that cost of building that granny flat, just remember you can write off those costs against tax. So in theory, you're not really paying for it. It's written off against tax. So that's a good thing to keep in mind. The other thing to do is, if you don't have the space to build a cottage, you can create another room that is isolated from the house but attached to the house and rent that out as a unit on its own, substantially increasing the rental yield of the property too. So there's many, many different ways you can increase the yield on these high growth negative cash flow properties by trying to make them either break even or even cash flow positive. The third strategy has got to do with the high yield properties. So these are properties that already have a high yield dynamic. They generally tend to be in regional areas where there is a high demand for rent, but not a high demand so much as compared to blue chip properties for purchasing of those properties. So they generally tends to be a lot cheaper, but the rental income streams as a ratio to the cost of the property, in other words, the yield, is positive cash flow. It's high. So if you've got a high growth property that's negative cash flow, purchasing a high yielding property in another area just improves the cash flow dynamics of your overall portfolio, allowing you to stay in the game. But it's very important, if you're going to go for a high yielding property, to buy it in the right area. It's not the topic of this podcast. However, in a general sense, when looking for these type of properties, it's always important to look at population trends of the area, income trends of the area, the business sector, the industry of the area. Make sure it's not a cyclical industry. For example, if it's just mining, because then in times of when China slows down, for example, like it is now, then the mining areas generally tend to suffer. So you don't want to have those cyclical areas. So it's good to see a diversification of businesses and industry moving into those areas. And you can see that through trend statistical data. So when we advise our clients on going into these high yielding properties, we always look at the socioeconomic trends of those areas to make sure that they will be worthwhile and less risky investments than you would typically find in high yielding properties. So that is very, very important. Then, of course, in those high yielding properties, you can improve the yield by using those strategies I mentioned in the high growth properties. So there's lots of tools you can use with property. They are such a great asset to improve your wealth. The fourth strategy I'd like to speak about in your portfolio is generally properties are long-term game. So you've got your high yield properties, you've got your high growth properties mix in the portfolio, but it takes time for that wealth to generate. So as the property valuations go up, the equity in those properties go up, you can borrow against that home and extract the equity to purchase more property. But while you're waiting to do that, there's other short-term gains you can use with the equity in the property. And those are holding properties for short-term, using short-term strategies. And I'll give you a few examples. One of them is doing a flipping properties. So you can purchase a property, for example, by buying them in a bear market like we've just come out of now. So we're still at the end of a bear market with it's turning slightly. So there's great opportunity. So opportunity to purchase a property now and then sell it in a year and a half time in the bull market. You'll get a nice property uplift. Secondly, what you can do is purchase the cheapest property, so to speak, in a neighborhood, in a good neighborhood. And there's a prime example of what I saw this weekend, a great opportunity in a great neighborhood. So I went to an auction. The auction was in Curl, which is a suburb in the Northern Beaches in Sydney. The home was a very old, neglected home in a very strong neighborhood like Curl. Curl's median house price at the moment is around $3.8 million. This home was going for around $2.5 million. Great block, north facing. If you had built up on the property, you would have sea views. So acquiring this property, you can do either a major renovation or a cosmetic renovation, and you're purchasing it at the end of a bear market, which is great. So by the time you take ownership of the property, do a few cosmetic changes or major renovation changes, by the time you complete that, you'll be entering into the next bull market. So the timing is just perfect. And the economic uplift in that short-term gain by putting in a little bit of extra capital into improving the asset will be substantial. it is a huge, huge opportunity. And these are great short-term strategies to boost your portfolio. Okay, so moving on. To summarize, property investment is a balancing act. If you purchase a negative cash flow property for high growth, bear in mind it's not going to be negative cash flow for its entire life. If you're holding that property for, I don't know, say 10, 15 years, the rental income streams will increase with inflation or close to inflation, depending on how you structure a lease. So eventually, the actual rental income streams as a percentage of what you originally paid for the property back 10, 15 years ago will show a positive cash flow stream. So that's the beauty of it. So just keep that in mind. Okay, so I'm going to move on to the auction clearance results for the weekend. Very strong clearance results in Sydney again. So Sydney clearing at a 72.5% clearance rate for the weekend, with New South Wales at 71%. Victoria also showing an increase over the week. Victoria clearance rate at 68.8%, with Melbourne clearing at 69.6%. South Australia is still the strongest clearance rate in the country at 84% for the state and 83.8% for Adelaide. Queensland clearing at just under 60%, with Brisbane clearing at 65%. Western Australia showing 33% clearance rate. It's probably a little bit of a misleading factor that looking at clearance rates in Western Australia, because the auction popularity there for homes is not as popular as in the eastern side of the country. So it's probably not a true gauge of the strength of the property market there. So it's worthwhile to keep that in mind. However, Perth on the auction clearance statistics is around 20-25%. I hope this episode was insightful and valuable. We look forward to seeing you on the next one. Thank you for joining me on this episode of the Valmika Property Investing Podcast. I hope you found our discussion insightful and empowering. If you're interested in finding out more about our services at Valmika Buyers Agency, visit our website at valmikaproperty.com. There you'll discover how we can assist you in making informed decisions and achieving your property goals. See you on the next episode.